for those who don't know me, we currently manage about 2.9 billion in gold and gold miners. That's more than twice than what we managed a year ago. And that is, to a significant extent, that fringe views are moving more towards the mainstream. Now, that doesn't mean that we are going to be this train wreck tomorrow, but this, especially the market I'm in, is not that huge, and you don't need that much money to move into that space to make a big difference. And so it's those bigger things that matter much more so that when we do on a daily basis, whether we have a little tax cut or tax hike, because that's really where the money is spent on government.
Look, I want to talk about gold because it's hitting new highs as we're speaking. But why are you now 2x what you were a year ago in gold?
Well, it's both inflows and the performance. I can't talk about the specific products that we have too much, but we manage one product which actually does not have any inflows or outflows. It's a closed-end fund. The other one is an open-end product that we manage, and both of them have substantially more assets than they had a year ago. And so it's the dynamics of the space we're in, and I would like to say on top of that we've done a good job. I leave that for investors to judge.
Well, but what I'm getting at with that question is, how does someone like me, I'm heavily exposed to risk assets, equities. I've got some cash to the side. I think people are, I'm very, a good description of the average investor in the United States. A lot of it was 401k. I'm exposed to stocks. How do I expose myself to gold? Should I expose myself to gold? And what are the real ways I can do that to minimize my costs, but to increase my protection against a potential downside in stocks?
Well, before I answer that question, it's important to note that my view is that you should look at your investments in terms of risk. That's what professionals do. What risk can you afford? And I'm not talking about the standard deviation of returns or whatever it is, but something that one can relate to. I like to say, well, whatever you can sleep with at night. And I don't mean the gold bar under your pillow. I mean that, we just talked about, performance in the gold space has been quite substantial. Well, what that means is things can also go down. Now, I happen to be positively inclined. Maybe it's an institutional bias, but something that moves up substantially can also move down. And before I answer what you should do, and by the way, by regulation, I'm not allowed to give specific advice, but let's think about the sort of investor that allocates to gold, and look at it from that context. There is the gold bug who is concerned about the purchasing power of the dollar, the fiscal sustainability. And as I indicated, fringe views are moving more to the mainstream. And so while many people wouldn't characterize themselves as a gold bug, we have more of those investors. We have the diversification investor. Gold in the long run has had a near zero correlation to equities. That said, it is not always zero. It rarely ever is. It sometimes moves with the S&P, sometimes against it. It is one of the more proven diversifiers. And in an era where many people think that the S&P 500 is top-heavy and might be highly valued, they're looking for diversifiers. There are more investors that have allocated to gold. Then you have a group, I think that's a very important group, is the speculator. The speculator is not loyal. They like a good run. And in recent years, those speculators had moved away from gold more towards meme stocks, towards digital assets and the like. And you actually saw that with the rise of some of the crypto ETFs, some of the big gold mining ETFs had some outflows. Now the performance was good, but they had some outflows. In recent weeks, as gold has been on a tear, we've actually seen some of those folks come back. The main implication for investors who are not speculators is that it creates more volatility in the market. And we've maybe just seen the beginning of that trend. Who knows?
Let me repeat what I heard you say to make sure we understand it. By we, I mean the people who are watching. I don't talk about myself in the third person. I'm not the emperor of Rome. What I heard you just say is that gold, the headlines on CNBC and on Yahoo Finance and on Fox Business, gold highs, might feed into a fear of missing out. But the metric you just gave us about the flows, there's a great deal of volatility in gold. And so those who are expecting some kind of event to either propel gold higher or lower should understand that taking on gold exposure at these highs, it's highly volatile right now. Is that what you were just saying?
It historically is volatile, and the volatility comes in spurs. It can be for an extended period. Gold historically has a volatility similar to the S&P 500, but it can peak out and go higher. And then one thing we haven't talked about so much is there's gold and there are gold miners. Now, many people invest in one or the other. I happen to invest in both, but the risk profile is different, as I just pointed out, right? The price of gold has a volatility similar to the S&P, can be higher. It's more for the defensive investor. Now, given the volatility, even though it's often classified as a safe haven, it's not quote unquote safe in a regulatory sense, because clearly relative to cash, the price moves. On the gold mining side, there's a whole spectrum of risk profiles depending on where you are. And for those not so familiar with it, on the major producer side, or in gold mining in general, the theoretical idea, and I point out theoretical, is that it's a levered play on the price of gold. When the price of gold goes up and the mining cost is fixed, you have a disproportionate gain. In practice, this has not happened most of the time, because when the price of gold goes up, several other things happen. Commodity prices, notably oil prices, historically also go up. About 20 to 25% of the cost of mining is energy. And so that dampens the margins. Workers want to have higher wages. Governments want to have more tax revenue. And so in previous cycles, it's often been disappointing. In recent times, costs are somewhat contained. Increasing those margins. That said, the market has not valued the ounces in the ground as highly as they have in the past. Now, that may be in part because investors have gotten burned maybe too many times. The other thing that happens, to keep in mind, is the gold mining sector has the greatest dispersion of returns. Now, that's a fancy way of saying that of any sector. It's a fancy way of saying that active management matters. The stocks do not all move in tandem. And the major producers, which are the ones that are part of the biggest ETF that's out there, they've had their own set of challenges. They overinvested 15 years ago. The market then told them, get your act together. Then they underinvested. And by the way, these big mining companies, they mine about 5 million ounces. They cannot replenish that a year with new acquisitions. And so of late, they've gotten involved in these huge projects, copper gold projects, different risk profile, taking more geographic, political risk on as well. At the other end of the spectrum, so I don't ramble here for an hour on these things, you have the junior miners where you're literally betting on them finding and being able to develop a gold mine. And so the volatility there can be rather explosive. And historically, that's attracted more of the speculators. So you have a huge range of risk profiles. Now, I haven't answered your original question, whether you should allocate to the space and
what should
how
I
much
consider?
So. Yeah.
The question is really, what should people like me, the average investor, consider if they're going to allocate towards gold or a gold miner?
Well, the first thing I'd like to tell people is have a process. You don't need to have a good process, but a process. If you don't have an investment process, you're going to listen to the next fellow on a podcast or wherever and make a decision, and then you're going to listen to the next guy and you change your mind. And the other thing I'd like to encourage people, if you buy something for whatever reason, remember why you bought it, and don't have your confirmation bias and justify, hey, I want to keep it that way, because there might be a time to sell it again. The gold miners, the advantage of them being so volatile, you don't need much of an allocation to get a good bang for the buck in terms of diversification, right? And of course, a lot of it depends on your outlook, and we can talk about the outlook more. The one thing that happens historically anyway, often in this industry, that when money goes into the sector, it often goes into the majors, and then with delay into the juniors, but because they're more volatile, with an amplified impact. And in recent months anyway, the majors have actually gone ahead, and the juniors have quote unquote just kept up. So if you take that prism, and I'm not making an investment recommendation or forecast here, there is a potential, and many gold investors think that may well happen, that the juniors have substantial potential on the upside, even though the run-up has been quite dramatic in recent months. And so but again, it's a speculative space, right? I mean, of course, I like it that I've come in earlier. I'm a significant insider holder in the space, and I haven't sold anything, if that's indication of how I think about the space. But it is a very speculative space, and so it's not for the faint of heart.
Right now, what do you think is driving asset prices in the United States? And I realize we have to figure out which assets we're talking about, but break it down for us.
Well, greed is, of course, driving asset prices. It always does. It's greed and fear. and so the way I look at the investment world, I'm known as a macro person. I've done deep dives into central banks and so forth. I'm at heart, though, a discounted cash flow person. And so when I look at the world, I look at it as relative to the anchor of risk that the Federal Reserve is providing. And when we're in an environment where monetary policy becomes more accommodative, that means that we're going to be discounting assets less going forward, which is a tailwind to asset prices. And there are a lot of people that say, oh, don't buy the Fed. Just as a fun fact, Treasury Secretary Bessent said he's made a killing betting against the Fed, but of course that the context is slightly different. And kind of that's more on nuances on where interest rates are going to be. But still, we've had this recession that has never materialized. And so for several years now, we're anticipating rate cuts. We're finally getting some of them. And so this drive to lower rates is overall providing a tailwind to asset prices. Now, as a gold investor, when we have a shallow recession, it doesn't have that huge of an impact because it's assuming that traditional risk assets perform well. But if you're in the camp that we have a more severe recession, well, in that environment, traditional risk assets historically perform poorly. And because of the anticipation of significant rate cuts, gold and gold miners really do well. And so in some ways, we have been in the sweet spot with an expectations of rate cut, and it's been dragging on and on and on, and we're nowhere near the bottom. And so we're not in this higher for longer environment. And by the way, one thing I should add on junior miners, while they tend to do equity raises, these junior miners need to go back to the funding market to develop their mines. I say they have credit risk in the sense that they need to go to the capital markets, and when you have a tight environment, those valuations are lower.